Yes, hello everyone. My name is Mark Barrett. I am a landlord, and today I'll be talking about structuring your business from overseas. Whether you're permanently overseas or an expat temporarily overseas, we'll be talking about both scenarios. Just to introduce myself, I'm a chartered accountant. I've been running the business now for quite a few years. Have a large practice in terms of the number of clients. We've got about 250 clients who are from overseas. I was a property developer. I was then involved in flips extensively. I am still a landlord. I've been a landlord now for in excess of 20 years. Whenever a professional is speaking with you, they've always got the same things that we're going to say to you, which is the information I'm going to give you today is an overview. That's all I can do in this sort of time. You must take advice that is based on your circumstances. So effectively, I'm going to give you the questions that you can ask your accountant. And if your accountant is not up to standard for this, please come and talk to us. You'll see our contact details at the bottom there, pin@expattaxadvice.co.uk. I very happily work with people from the PIN family. I think you've got the best of the trainers with Simon. He's the trainer who trained the other trainers. So do you want the teacher or the student? So you're doing well by talking to Simon. And by using PIN@, it just simply tells my staff that we'll give you some priority to try and get through if you need a conversation with us. Okay, two fundamental questions. It's very normal for property people, particularly, to look at what's right for you today. Probably more frequently is, I really want this deal to work. How do I make this deal work? Please don't do that. Try to focus on your horizon. You're involved in this business for a reason. You've got to try and walk towards your horizon. We've got to make sure the structures that you have are in place to get you from where you are today to where you want to be. As an overseas investor, I'm afraid there is an additional question that I have to always look at, which is, where do you want to eventually live? You're overseas at the moment. Are you always going to be overseas? Or are you an expat and anticipate coming back to the UK? So it is this distinction between looking at the short term and looking at the long term. That's really important. And therefore it leads you into the business planning process. Now, I think there are 3 steps to the business planning process. Obviously, I don't know who's listening to this presentation. I don't know your circumstances, but there's nothing magical here. This is normal. This is what you should be doing and probably do in your life anyway. The first step is define your strategic plan. Try not to use too many techie, but you understand what I mean by strategic plan. What's the end destination? Where will you get to? What's retirement like? What do you want? More passive income, work-life balance, legacy? What is it you want? You can see that I'm going to deal with some of that more in a moment. But once you've got this long-term target established, now we've got to work out the next stage. The next stage is, how are we going to get there? Your business plan. Now, there could be several business plans which coalesce together to develop the long-term plan. So you may want to be involved in passive investment, but you may want to start getting involved in flips because that creates cash, which creates deposits. Whatever the circumstances are, work that business plan out. How do you get from where you are today to where you want to be in the future? So having developed the strategic plan, now the business plan, the obvious one that's left is, how the heck do you start now? What is the implementation plan? So you know the end game, you know the process you're going to get there. What is the action list? What do you do and when do you do it? So I said we're going to do some more work on the strategic plan. So that's what I'd like to just spend a few minutes now addressing that topic. Your plan must be personal to you. I see it on a regular basis on social media, including from people who are very educated within the PIN family. They still fall into this mistake. Do you think I should do this or that? And you get, I saw one this morning, 77 answers so far, 77 answers, but nobody's asked the questions. They're all just given opinions. There's not advice, it's opinion. You've got to look at the factors that affect you when you make your decisions. Now, a lot of people will say, are you a higher rate taxpayer or lower rate taxpayer? And they think it's a binary choice, that simply deciding, oh, well, I'm a higher rate taxpayer, therefore I have to be in a limited company. It isn't that binary choice. And that's really important. I've had the situation many, many times now where I can create a structure which is very tax efficient for a person for 5 years. Trouble is, they're 30 years of age, they've got a plan that in 5 years' time they're going to do this. And damn, if I've enacted that plan for them for a 5-year tax efficiency, I can give them 35 years of tax inefficiency. So it is feasible that you can actually end up deliberately choosing a tax inefficient process to start with because it fits your longer term plan. So please do not get carried away with this binary choice. Is it tax and structure? You mustn't let the tax tail wag the dog. I do use a lot of expressions, so if any of you know me, you'll know I use a lot of these expressions. The things you should be thinking about, and there's just a smallish list here. Age, marital status. What do you want to do with the kids? How are we going to protect you from your kids? If we're going to start to bring your kids into ownership, what do we know how they're going to behave when they're adults? What happens if they get divorced and start taking away some of your assets because you've started to give them assets? When do you want to retire? Where do you want to retire to? And that's obviously a big one for a lot of my overseas clients. So it's a huge list, and this is not a comprehensive list. This is simply a sample of the sort of questions that we would go through with the client when we're trying to establish a plan for you. So think about these types of things. Do not just come focus on tax. There's more to it than just tax. So let's talk about some of the issues. Are you a permanent non-resident? Now, as I said, we've got about 250 overseas clients. About half of them are permanently non-resident. They're never going to come and live in the UK. They don't want to come and live in the UK. They want to invest here because we have commoditized property. And in reality, that's what the English have done, what the British have done. We have commoditized property. So the starting point, if you'll never live in the UK, we need to think about, where are you going to live? Now, I fully accept that most people don't actually have that choice. People are transient nowadays. They might be working in one country, but they have the intention to live eventually somewhere else, but they're not certain. And that's okay. Do we need a corporate structure? That's one of the first questions that we're always going to ask. Can we put things in your name, or do we put things into a corporate structure? That does depend on the size of your planned portfolio. If you imagine your intention, and it can happen, that you say, never been a landlord before, I want to have a property, I want to see if I like it, damn, I hate it. Well, did you really want to have a corporate structure that you've got to sustain? Or should you put the first property in your own name? Maybe you're overseas, you don't have any other income in the UK, the first property can sit in your own name, maybe that's very tax efficient for you. Maybe you've decided that the right choice for you is a corporate structure. Absolutely fine, but let's decide that early days. And that goes back to the previous slides, doesn't it? This is the toughie. Do you know now where you intend to live permanently? Many people I talk to don't know that. If you do know where you intend to live permanently, remember I'm talking about the permanent non-resident here, maybe we ought to now identify which country you're going to live in, if that's feasible. And let's think about working with an accountant in the country you're going to end up in, or stay in, or whatever the words are. Because whilst we can have a corporate structure, for example, in the UK, I know, I'll give you an Australian example, it's not unreasonable to create a corporate structure in Australia. If you happen to be an Australian and you want to live there, good, create a corporate structure in Australia. The Australian company now has a subsidiary in the UK. So we've got to get to your plan. We've got to understand, what do you want? And therefore we've got to create this holistic plan. It's got to be all embracing on what you need and where you're going to be, because we don't want to create something today that causes you problems tomorrow. Hopefully this is all making some sense. It doesn't matter if you haven't decided where you want to live. And as I say, it's not unusual, because we can then create a corporate structure that creates some flexibility. Now, I'll describe that in a few slides' time. Overall view for a permanent non-resident, that would be the sort of stepping stones that I would work through as to what is the right thing for you. Now, let's look at the expat who does intend to return to the UK. Again, I'm going to talk about the size of the portfolio. Do you want 1, 2, etc.? There are some nuances that are slightly different for an expat. And there's one of them that's got really exciting language. Excites an accountant. I apologize, but accountants get excited by things. I'll show you that in a moment. If you're planning to return to the UK, then we need to delve into your plans of when do you intend to return, because we now got to look for that short-term and long-term efficiency. I don't want to create something that's very efficient whilst you're out of the country, only to make it disastrous for when you come back. Okay, so we've got to focus on that long-term plan. This is the bit that gets me excited. Can you see the words on the bottom there in brackets? Disregarded. I only think that if you can start telling me that some income is disregarded as far as my tax is concerned, I like the idea of that. So, do you have any other UK income? If you're a British citizen, then there are extra tax rules that apply to you compared to non-British citizens. There is this extra consideration called disregarded dividends. Let's think about these things. Let's explain how they work. And we will educate you to make sure that you're making the right decisions. It's not us that makes the decision, it's you. So I have to educate you. That's an interesting one to go through. Simply that there is some income that you can make in the UK and you never have to pay tax on it because it is disregarded. So for those of you that have got any expats listening who've got dividend income out of the UK, do check as to whether disregarded dividends is applicable to you. It's exactly the same phrase as I used on the last slide. We can create a flexible structure. And again, we're going to talk about that shortly. So, 2 initial decisions that you'll have to make. Do you want to trade, own property in your own name or in a company, or maybe both? So there's actually 3 options there, isn't there? Your own name or company or both. Very important. Go through the strategic plan, the business plan. Let's work out how to get started. Maybe there is a process that you start in your own name and go to a company later. You probably won't transfer properties from your own name to a company. We do that work for a lot of people. They ask us to investigate it. Probably 10%, 15% of all the people that actually instruct us to do a portfolio review and see whether they can move the property actually decide not to. That means 85% have wasted the money of asking me to do the work and of investigating it, but at least they've got knowledge. But you probably won't be moving property from your own name to a company. If you're going to trade in a company, shall we have a group structure or not? Now, group structure, slides will come up shortly about corporate structures, so I will be getting a bit techy in a moment. But a group structure is effectively a top co, and it's the top co owns active companies below it. That's all a group structure is. Group structures are very efficient. They're very tax efficient. So the advantages of the group structure: you can permanently move money tax efficiently between companies. Quite important. Probably easier when I get to the next slide to come back and talk about how this works, but the permanently moving money. It also protects your investments from your trading activities. Let's imagine that you're operating as a consultant, or you plan to operate as a consultant if you come back to the UK. Maybe we need to put that into a company, but we want to protect your investments from your trading activity. In life, it strikes me that every time there's a positive, there's a negative that balances, yin and yang. So there's disadvantages. There are less lenders who like the hierarchical structure. So if you think about what I've just said, you've got yourself at the top, underneath you is a group company, and underneath the group company are some active companies, investment companies, trading companies, whatever, 3 layers, hierarchical. Right now, British banks are an absolute pain in the proverbial. You can't, they're making it so tough to open, even open a bank account. They've made mistakes. I've actually had bank managers admit why they are causing pain right now. They've made mistakes and they're causing pain for us because of their mistakes. During this period of COVID, I hate using that phrase, but never mind, during this period, the banks are even more difficult. Therefore, if this creates less lenders, do you want to do it right now? So timing of the group structure is going to be important, and there is a slide coming up on that. Once you get to a portfolio landlord, 5 or more properties, the effect is reduced, eliminated, because less banks like that anyway. So these are what I consider to be your initial decisions. So let's go on to a techie slide, shall we? Hopefully you all understand the phrase a helicopter view. Helicopter view is very simply, it's a very high level view. If you imagine you've walked out to the helicopter parked on the ground, you can see the blade of grass under your feet, you get in the helicopter, it goes up, and eventually you get so high, you can see that there are trees, but you couldn't tell a birch tree from an oak tree. All right, it's a helicopter view, high level view. Simon, I think, is one of the best tutors ever. Really do. That's why I do these presentations on behalf of PIN family. He uses 2 descriptions, either an investment company or a trade company. I use 3. It's not that we disagree. I've broken down what Simon describes as trade into 2 segments. So that little box is a company. And if you think about what that company intrinsically looks like, keep it very simple, it has a lot of assets in it, but hopefully the human isn't working very hard. It is your desire for passive income. So what is it doing? It is your buy and hold strategy. It's your HMOs, BTLs, it could be your commercial. It is your investment company. That needs to be an SPV. Again, I know that everyone will tell you that's called a special purpose vehicle. Accountants don't like the word special because it's too exciting. We're not very exciting people. I prefer a much plainer language. I use single purpose vehicle. It is a company formed for a single purpose. It's a very easy definition. What is an SPV? It's just a company, but it is formed for a single purpose. Okay, there's your investment company. I appreciate that most people are overseas, but there are some who are operating what I would call a service company. Most people won't. It's quite tough to operate this, but it depends upon your relationships in the UK if you've got a UK person that you work closely with. So I have included it in the slides because I want completeness. Think about this type of company. This one doesn't own any assets, but it puts a lot of effort in. It's a job. It's a doing operation. It is your do strategy. It could be rent to rent, could be rent to SA, packaging, letting management. It could be your consulting company. It could be your training company. It could be another service company, for example. As I say, trying to operate rent to rent from overseas, doable. I've got clients that are doing it very successfully, but they've got a UK presence to help them with that. So the third type of company, now again, Simon quite rightly describes that as a trade company. It is. HMRC define that as a trade company rather than the investment company. I've broken trade down into 2. Service, which is my do strategy. I'm now using the word trade, but I'm using the word trade by way of tradesman. So please, when I use the expression dirty hands, it's builders, okay? You own the asset, you work really, really hard on it, but temporarily, and then you sell it. It is your buy and sell strategy. Could be new builds, could be flips. Now, I think at a helicopter level, every single property strategy that exists could fit into one of those 3 camps. You're either going to buy and hold, you're going to do something with somebody else's, or you're going to buy and sell. Fine. There is a potential 4th company. That is the holding company. Now, I refer to it normally as a group company. Obviously, I've used the word holding here because that's the parlance that everyone else tends to use. I don't like using the phrase holding company simply because I'm using hold in my investment word in my investment company. I don't want to use the word hold too often. So holding company, or I prefer group company. Now, think about this structure. It's a very simple structure. You sit above the holding company, of course. Excuse me, I'm going to cough. What a lot of people might do is you might have one of the two trading companies, a trade company or a service company in my description. And what's their job? Their job is they go out and they flip property, for example. What do you do with the money? Well, let's assume that you're okay for cash. You don't need any income from it. What do you want to do with the profit from that flip, which is now sitting in your trade company? Well, you've got to try and move that profit across to the investment company because you want to buy some more property. It's your deposit factories. That trade company can become like a deposit factory. Hopefully everyone's okay with that language. It's where that's what I did. I created deposits using my trading operation. By using a holding company, I can move profit by declaring a dividend from the trading company to the owner of the trading company. Well, the owner of the trading company is another company. So one company declares a dividend in favor of a second company, a holding company. There's no tax on the movement of money. You do pay tax in the trade company, but you don't pay tax to declare the dividend. The holding company's now got the cash. It looks at you and says, do you need any more money? No, you don't. You've got a good job. Well done. Good. I'll move the money over to the investment company. I'll buy some more property. So there is the big advantage of the holding company. It can move an asset. Now, whilst I've just referred to cash, it can move property as well. So you can build something in a trade company, a block of flats, whatever, decide to keep one or two flats. You can pass them via the holding company and not pay stamp duty, for example, to move them to your investment company. So this is a fairly simplistic structure that I've created here now, but it's efficient. But do remember what I said on the other slide. At the moment, the banks have been a real pain. They are struggling with this principle of hierarchical, and they're trying to find excuses not to lend you money. I will be coming on to when to create a holding company shortly, and I think I've got 6 minutes left to do that, so that's great news. Okay, so I've referred to the SPV, the investment company, as an
Sorry, Mark, you can have longer if you need it. Don't worry, you can have a bit longer if you need it. Don't rush.
I'll take any Q&A if they want to, but that's fine. Thank you, Simon. Right. So I refer to the investment company as an SPV, a single purpose vehicle. Please understand that that trade company is also a single purpose vehicle. Now, the reason it's a single purpose vehicle is because it has completely different levels of tax. It has some extra compliance activity. So, for example, it has something called CIS. It has something called CITB. It has something called CIL. Lots of anagrams, okay? Construction industry scheme, construction industry training board levy, community infrastructure levy. So they've got extra taxes going on in that trade company. So try to keep it separate, okay? Don't try to mix them up. If you mix them up, you can cause yourself all sorts of problems. Really important now, please, if this is making any sense to you, and if you have any urge to have a group company or holding company, please keep this in mind. That topco group company must never trade, must never, ever, ever trade. It has one job only. It is an SPV. Its single purpose is to own shares in other companies. That is its only job. Now, let me explain the reason why. This is really important. I see too many people making mistakes. Please don't. Visualize that you're doing this. I know you might not be interested in all these strategies. It doesn't matter. Just visualize for a moment you're doing this. You're doing flips. It's very successful. Great. You bang the cash through and you've been making your investment company really successful. You're creating lots of wealth. Brilliant. Lo and behold, 5 years down the line, now your trade company has done a development and it's gone wrong. you're going to go bust. You're going to have to liquidate that company. By being on the bottom row, providing it hasn't guaranteed, no one above it or anybody else has guaranteed anything, we can close that company and it doesn't affect anything else. Right? So we've protected the other companies by keeping it into that bottom row. But if you now visualize that your holding company has started trading, I don't know what, you've decided to do some rent-to-rents through, I don't know what you're going to do, and it goes bust, everything below it is forfeit. You lose everything. All right? Keep that holding company, that group company, as a single purpose vehicle. Okay? Very important. You won't like it because all you'll say at the end of the year, but Mark, I haven't done much with that company. All I've done is pass money through it. It hasn't done anything, and I've got all the costs of looking after it. Yes, I know, but if you try to operate the cheaper options of trying to get that company to do things, you're creating a huge amount of risk. I do like Zoom because I can see that people are writing notes. That's really good news. Last thing on this slide, I know I spent a lot of time on this slide, but I think this one is quite interesting for people. Stand back, look at this. At the end of the day, those three bottom companies, those three subsidiaries, think of what their purpose is. I know I've used hold, do, sell, yes. Now let's use some really basic language. I think the trade company is a deposit factory. Right? If a person, let's imagine you came back to the UK and let's imagine you're operating a service company. What does the service company do? It is an income generator. It's a job. So I think the trade company is a deposit factory. I think the service company is a job. It's an income generator. First one's a deposit factory. Second one's an income generator. Investment is your wealth. That is creating wealth. And at all times, we want to protect your wealth. Keep that one as clean as you can. Keep it nicely tucked away, very clean. Okay? So let's get to the next slide. The next slide, oh, sorry, there's some more words on there, I do apologize. I've left these words on. I've talked about the investment company, the trade company, and the holding company being SPVs. What's the service company? It doesn't have to be an SPV. It really doesn't. There will be some things, some activities such as deal sourcing because of the amount of complexity and compliance activity in there that you say, because of the risks, I do want to isolate that into its own little service company, but it is possible to use what my language, this is, you can't Google this and find HMRC talking about this. In my language, you can create what's called, I call an incubator business. So you can create lots of different types of service activities in that company whilst you're checking to see if these are viable jobs for you to do. Okay, now we'll go to the next slide. Oh, sorry, I'm going to go back. Please, excuse me. I've said twice during the presentation there's a flexible structure, and I haven't explained the flexible structure. So let me do it now. The investment company, the service company, the trade company need to stay in England. They have to. The taxation, I'm not going to be anti-government, or because it's too easy to be anti-government, whichever government your country is in. The British government has created a situation where they've made us a bit of a tax haven. I know if you're in Dubai, for example, you wouldn't think of us as a tax haven, but compared to some of the other Western countries, we're a tax haven. 19% tax on business, not bad. And as they lowered our tax rate, the tax yield for the country increased dramatically, right? The year that they decreased our tax rates, the yield went up by 6% the year after because more people are doing business. The government is massively keen to encourage all of you listening to me today who are overseas to invest your money in the UK. The government wants you to invest in the UK. They want your money, but what they want is 19% of the profit. So they want to encourage you to come into the UK, be successful, please, because we love entrepreneurs and they just want their cut. So it feels like it's the mafia. They want their cut of the profit. Well, that's what governments do. These companies need to stay in the UK. The rules to have an overseas company investing in property, quite tough, quite penal. But you can take that holding company abroad. So we could form that company in the UK. You haven't decided where do you want to live. You're an Englishman or a Brit. You said to me, Mark, I'm definitely going to return to the UK. 5 years later, you said, no, I changed my mind. I'm not going to. That's fine. If we've created this sort of structure, we could move that holding company offshore. So you can then decide you want to live somewhere else. I'll give you an example. Let's imagine you say you want to live in France. I will say to you, leave the holding company in England, just take the dividends because you don't want Napoleonic taxes. The French are quite heavy at taxing. You tell me then you want to live in Switzerland. Fine, no problem at all. Take your holding company and go and live in Switzerland with your money. Take your money, take your holding company with you. So this has some flexibility to it. Yes, there is an aggravation to move the company. You pay people like me to do it, but that's fine. It's only a one-off cost. You could create this as a flexible structure because you can move that holding company offshore. Okay, that was my flexibility. Okay, last slide. I've talked about group structures. Now the question is, when do we want to create a group structure? Remember the slide I've just done? 4 companies. Do you really want to form 4 companies today and pay for them all to be looked after when actually you're only just starting? It doesn't make sense. Why don't you just start with the one company that one activity you're going to get involved in today? We'll put the rest in later. So when should we create a group structure? I do use the phrase rules. This isn't a rule. It's not my job to tell you the rules. I can't give you rules, but it's a nice 4-letter word. The alternative was guidance. It just ruined my slide. So I use the word rule, okay? The benefit of the group structure is allow you to move cash between companies. That's its big benefit. You could move property as well. If you think you're going to be so super successful inside the first year, then we know we need a group company in the first year. Well, you must as well form the group straight away then. So form the group, and then we can form the subsidiaries at the same time or straight after the group. So if you're going to move cash inside the first year, then form the group straight away. If you came to me, I would argue against you doing this because lots of people have lots of brave intent. Yes, I'm going to dominate the world within 6 months. Okay. I'll argue against you and I'll press you quite hard not to spend money too fast. But let's imagine that you've got a viable plan. Good. So there's number 1. I'm going to go to number 3. If it's going to take you greater than 2 years before you make sufficient profits that you need to move it, sorry, have a sip. Before you want to move cash, then form the group later. Okay, don't have the group straight away. We'll do it later. That's more than 2 years. Now, it's obvious I haven't given you what number 2 is. So that leaves number 2. And it's the tough one. Because you say, well, it's not realistic that I can be so successful inside the first year, but I really expect to be successful in between years 1 and 2. And this is all about a cost benefit analysis. That's what I'm doing this for. The cost of having the group company compared to inserting the group above the other companies is about the same. So therefore do it later. I'd much rather hedge on the side of let's not spend money too early. It is a simple cost benefit analysis. So let me explain the cost benefit analysis. If you visualize that you've got the group company, if the group company is there, but you've never used it, but it owns an active company, it needs to file accounts. Even if the accounts are full of zeros, doesn't matter. you need to file accounts. You need to file a tax return because it has a subsidiary that is active. Therefore, do you really want to have to pay the accountant for the accounts of a group company? Probably not. But if you put the group company in later, then we've got to go to HMRC and effectively ask their permission. It's not the correct words. We ask them for clearance, approval that we can do this, and you're not going to come and hurt us later on, Mr. Taxman. And the cost of the clearance to insert the group has a cost to it. So we're looking at the cost of these accounts for the group company and the cost of the clearance. So if you go back to rule 1, if you're going to move money between the companies inside the first year, well, you're going to need a group anyway. You might as well just do it straight away. Don't ask for clearance. Don't spend the extra money. Rule 3, if it's more than 2 years, well, okay, if it's more than 2 years, if you form the group straight away, the annual cost of looking after a group company for 2 years is more than the cost of the clearance. Rule 2, actually, it's about the same. The cost is about the same. So if that structure of a group makes sense to you, then you've got to answer the question, when, because we've got to try and preserve money. We don't want to spend money too fast. So what I've just given you there is a 45-minute or 40-minute whistle-stop tour of corporate structures of investing in the UK from overseas. And hopefully that has been of interest. You can again see our email address at the bottom there. By all means, connect with me on social media, etc. Or email me if I can be of service to you. And that concludes my slides, if Simon is there.
Oh, thank you so much, Mark. A huge amount of information in there. And your contact details are actually in the back of our workbook as one of our power team. And one of the things that you're doing, Mark, is you've offered to have an initial 30-minute conversation. It's not advice, it's just a conversation to give people a bit of guidance on what they can do. Obviously, if they need to use you, obviously that's a paid thing later on, but they can have that initial conversation, and all they need to do is to use that email address so they know you're one of our clients.
Yeah.
Contact you, and your team will book that in. So the sooner they book that, obviously, the sooner they get to speak to you.
Yes.
And lots of great information there. Let's go to Andy to see if there are any questions. If you've got a question, type in Q. Now, please bear in mind, guys, don't say to Mark, here's my situation, because it's going to be different for everybody. So let's not talk about anything personal. But if you have a question you think would be beneficial for other people as well, that's the kind of question we'll take. Is that okay, Mark?
Yeah, absolutely fine. Do try to avoid your personal circumstances. And the reason why, if you do the intro call, and if you use the PIN@ email address, my staff know that you're to be prioritized because you're part of Simon's PIN family. What I don't want is for someone to come and say, well, go on, design my company then. I've got half an hour free. No, it doesn't work like that. I can't give you professional advice because I've got to know the client. There are accountancy rules, and it makes logical sense. You've got to know the client. And it will take me quite a while to actually unravel everything about who you are. And even if I tried to do that, I couldn't even get that part done in half an hour. But I can give you headline information. Let's not call the word advice. Okay.
Yes, absolutely. Great. Thank you, Mark. That's nice and clear. Annie, any questions?
So if you've got a question, then please do write a question or the letter Q into the chat box, and I'll spot that, and I will then ask Mark your question. Maybe I can kick things off, please, Mark, is that if I've got a group structure and I've got 3 subsidiary businesses,
yes,
do they all have to have the same tax year end, or can they vary?
Oh, they can vary. Usually people find it more convenient to have the same, but they don't have to, right? The logic of that is, whilst it's quite small, actually, the valuation of the subsidiary at the date of the group company's year end isn't that difficult because it isn't changing dramatically. As you get bigger, it is better that we have them coordinated and aligned.
And Mark, one of the things you've touched on, the reason you have these different companies, you've got your investment companies, I would call it, your buy and hold for your properties you're getting a mortgage on, and you've got trading business. The lenders in the UK will to give you a mortgage on a property, they won't give you a mortgage if you've got a trading business. So they'll only give you a mortgage on an investment business.
Correct.
Thus, if you're doing things like you want to do deal sourcing or purchase lease options, which I say is a trading activity, you'd have one company to do that, and you'd have one company to actually own the properties that you want to get mortgages on.
Perfect, perfect. Can I spend a moment on PLO just to help?
Please do, yes.
Great. For those of you who are making notes, and it is nice on Zoom because I can see the heads bobbing up and down as they make their notes, write down PLO and underline the L. Underline the L. Doesn't that look like a rent to rent? It's somebody else's property and you've got control of somebody else's property. So if you go back to the slides, actually it's a doing strategy, isn't it? It's a service activity.
Yeah.
Now write down PLO again and underline the P. It's an investment activity. It is the one that always sits in two camps. So typically, if you're operating PLO during the lease period, you will keep it in your service company, your do strategy. But Simon, if you listen to the training, please, it's wonderful. I attend physical events when we could in this country, and there's this lovely mantra that everyone says within his mentor group, which is just do what Simon says, will you? Just do what Simon says. And it's right. And I've listened to Simon for many hours, and I've never managed to pull him up yet. So that's quite good. The PLO contract must be assignable. You must be able to assign the contract. Sorry, Simon, if you're going to have to deal with this, I apologize. But
no, you're exactly what we said already. Yes, absolutely.
Great. Because I want to create it, I want to hold it in your service company. And then at the point when you want to purchase it, I wish to assign it over to your investment company.
Yeah.
Is everyone okay with that? So the PLO is a brilliant strategy. Works really well right now. But it is one where you start off with service and assign over. Now, I would tend to say that any contract in your service activity needs to be assignable. Okay, because you may want to, this is getting techy and I'm not going to go into the detail, but if you can imagine that you've got 3 or 4 service activities, make sure every contract is assignable, because at some point you might want to break those 3 or 4 activities out into separate companies. You might want to, and there is a good logic to it related to VAT and something called disaggregation, but I won't bore you with VAT right now because I'll put you all to sleep. Yeah, PLO lease sits in your service company.
Fantastic. Great. Any questions, Andy?
Yeah, thank you, Mark. Let's go to a question then from Christine, who's saying, Mark, if we want to set up a joint venture with someone, say 50-50 joint venture, what kind of a structure would you use for that?
Okay, perfect,
Mark,
Christine.
Sorry to interrupt, Mark. I actually have a slide on that. So we show my slides, and that was just what we're coming to, Christine. So you're anticipating it. And you're happy with this, Mark. But this is what I would suggest we do. So hopefully, if everyone can see the slides now, you might have a company, an SPV, a single purpose vehicle, as Mark would say, that buys the joint venture. But rather than owning shares in your own name, your holding company might well own the shares, your shares in the joint venture co, and the other person's holding company would own their shares in the joint venture co. That means that the joint venture co makes its money, and then profits can be sent back to your individual companies to pay the tax. So we were going to, that's on the slides because I knew it wasn't in Mark's slides, but I'm sure we're going to ask the question. I hope that's as you would do it, Mark. I'm pretty sure it is.
I'm not being funny. I am a fan of Simon's. Okay, I'll just tell you that I've never managed to trip him up yet. That is exactly what I was going to say. But I'm going to say a couple of extra words, if I may, Simon.
Please do. Please do.
If you put your slide back up, Simon, please, and let me talk over it for a second.
Yep.
Great.
Put it on the screen, please, guys.
So there is their holding company, all right? What you want to try to do is to ensure that the owners are the same. In other words, if you're going to use your holding company, let them use a company as well to own the shares in the JV. What you you can do it. There's nothing legally wrong, but it is potentially a problem if you own your shares from a limited company and they own their shares in their own name, because you've now mixed that top line. Okay. Now, the reason that causes a problem, and as I said, there's nothing legally wrong, you can do it, is that the attitude towards when do we take our profits changes. Because a person that is owning shares in their own name might say, whatever you do, don't give me my profit now in December. Wait until April, please, because you're going to ruin my tax bill for this year. Whereas you're sitting there with a company saying, no, I want my profit now because I've got a deal I want to fund and I want to extract my profit. So all of a sudden there's now tension in the joint venture simply because you didn't think about the structures properly. Okay. So that top line, if you can keep them the same, I would strongly urge you to do so, but don't put them in your own name, use your company. So persuade your JV partner if they can to use them in a holding company as well.
Great. And there's one other thing that I wanted to make sure we cover off that you can share with us. And that is that if someone is based overseas,
yes,
and they are then putting some money into their UK limited company, which is going to buy properties, okay, they will make that a director's loan. They're lending money into the business.
Correct.
And one of the things I wanted to cover is that actually there's a very good thing you could do. You can take money. So the UK company makes profit. It's got to pay the corporation tax, currently 19%. But then once there's profit in the business, the overseas investor can take that money out of the UK company back to their own company. And because they can do it as a loan repayment, there's no tax to pay on that.
Correct. Absolutely correct. All I would ask is, sorry, let me say it again. Absolutely correct, right? You put your loans in. When there's cash available, you don't even need to have made a profit, but when there's cash available, you can extract your loan back to you and there's no tax. But as with everything related to business, get your paperwork straight. There should be a loan agreement. There should be board minutes in the company that authorize you to make a loan to the company, right? As I say, the government is massively keen on overseas investors investing in the UK. They're massively keen, but they've got taxes, they've got rules about it. Please comply with the rules. So one of them is you can't loan money to your own company and say, fine, I'm going to charge your interest to 40%, because it's not a commercial rate of interest, right? So there are rules. Talk to your accountant. If your accountant can't help you, talk to us. Get the paperwork straight. But 100% correct. You loan money to your company, you can extract the money back out, extract your loan back out, and there is no tax on that loan.
Excellent. Thank you. Great. Andy, any more questions?
Yeah, so we've got a question mark from Halim, and you maybe have touched on this a little bit by way of moving back directors' loans.
Yeah.
But let's just say that we've got one investor who's based in the UK, the other joint venture partner is based overseas.
Yes.
How does the company deal with tax because they're in two different zones?
Well, certainly the JV company itself will be situated in the UK because an active company ought to be in the UK. It will pay its tax currently at 19%. Now we've got the extraction of the dividend. So the dividend coming back to you is to the UK company. If it's a company, there's no tax on that dividend from the active company to the holding company. Now we've got to look at how we own it, the owner of the company from abroad, the other JV partner, how are they holding that ownership? Are they holding it in their name or are they holding it in a company? We then have to get to the double taxation treaty. We want to make sure that when you've structured this JV that you have taken advice, because I want to know where this investor is, because I want to look at the double taxation treaties to make sure that I can get that profit repatriated to them tax efficiently. We don't want to see double taxation. Okay, every country will have a double taxation treaty. For those who are worried about Brexit, Brexit does not affect any of the double taxation treaties. It just doesn't affect them. Okay, it's got nothing to do with EU law. It is a treaty between two countries, which will exist after Brexit. Okay, so the answer is there isn't a common answer. I have to look at where is your investor, which country is he in, what's the tax position there, whereabouts you going to, blah, 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 all the things I've talked about already. And now I look at the double taxation treaty to make sure we get something that's appropriate for you and your circumstances.
I suppose another way of doing this, just going back on what we just said, Mark, is Halim, let's say you've got your UK company and that's owned by you in the UK, and you've got your JV company. Your overseas investor, the best thing I believe is to get your overseas investor who might have a big pot of money to set up their own UK company.
Yep.
That UK company then lends the money to the JV company. And as we said before, once it takes it back to the JV company, that original loan could be repatriated back without paying any tax.
Correct. Absolutely. Everything you just said, totally agree.
I mean, it's a bit of a hassle to get someone to set up their own UK limited company, but it's perfectly possible to do. Obviously, Mark can help with that. And actually, if they've got a serious amount of money, that's probably the best way for them to do it anyway.
Yes, and it means that I would end up talking to the JV partner. Let's imagine it's me that's doing the work. I would end up talking to the JV partner. I would go through that process of where do you want to live? Do you have any other interest in the UK? Do you have are the children going to be educated here? I don't know what their issues are, but let me understand their issues, and then I can find the right solution for them based on their circumstances. Usually, as Simon says, the answer is fine, let's create a UK company. But now we're back to that situation of, is the JV partner got a company in Lebanon, which was one I've just dealt with last week? Good, we'll have your Lebanese company create a subsidiary in the UK, and we'll reroute the cash from the individual to his Lebanese company, from the Lebanese company to the English company. So the money's bouncing. Yeah. Because it was efficient for him to use his Lebanese company. But that's right. Each person's scenario is the same. And I'm sure Simon is, whilst we talk about JVs, I'm sure Simon is going to talk about it. Please don't jump into 50-50 JVs all the time. I'm sure you're going to be talking about that, Simon.
Yeah, doesn't have to be 50-50. Yeah, absolutely.
Doesn't have to be 50-50. Don't give it all away, please.
Yeah. Well, we said private loans are better than giving it away a joint venture, really. But sometimes a joint venture can be appropriate, but a loan's better where you're not giving away all that cash. Yeah. Right. We'll just do a couple more questions. I know, conscious of time for you, Mark. Thank you so much for giving us so much time, which is great.
Thank you. Well, we've got two questions on Zoom, one from Jenny, one from Lisa. Let's start off with Jenny and ask your question to Mark, please.
Hi, Mark.
Hello.
Hi, I can't see you anymore, but that's okay. Oh, yeah, now you're there. Talking about private loan. So, if I got like angel investors in Hong Kong, that's where I live, and then I actually change the money into pounds and transfer it to my UK bank account, and then I need to take out dividends, and so I can still like take it out as directors' loans dividends, and then I just pay it back to my investors without paying any tax, right?
Yeah, the situation you would have probably, if I've understood you correctly, you've got Hong Kong investors who are going to loan money to you in Hong Kong.
Yes.
So the relationship between the investor and you is dealt with in Hong Kong, nothing to do with the Brits. All right. Now, obviously, you'll be paying them an interest, a premium. Okay. So when you loan the money to your UK company, you want to be charging the UK company interest as well. Because you want to pass on that cost to the UK. Does that make sense?
All right.
So let's imagine that you're paying your investor £10,000 interest this year.
Okay.
Do you want to pay that out of your profit, or would you want the company to pay that interest and get the tax relief in the UK, and pay you interest for you then? So in Hong Kong, you'll be sitting there saying, well, fine, I've got an interest income of £10,000, but I've got an interest expense of £10,000, which are offsetting each other. So you have no earnings in Hong Kong from that 10,000. Does that make sense?
Yeah. Okay.
Yes.
Well, yes and yes and no. I just because I would kind of let this put the other way around so that maybe I can understand better. So I'm just worried that I am paying tax also for my private lenders in Hong Kong. If I'm just taking out dividends from my company's profit and I pay them back in Hong Kong, that means I still need to pay the tax in the UK, right?
Yes.
Is there any way to offset that, or I just need
Yeah.
to?
No. Okay. I'll happily take this off this meeting, and you can contact me separately if you wish.
Yeah. Okay.
But what I tried to do was to tell you how not to end up with an expense. Okay.
Yeah,
So I have tried to explain how for you not to lose money on this one. All right.
Okay.
So I'll do it again, and if it doesn't fit, drop me an email and we'll arrange a private Zoom.
Yeah.
Okay. Hong Kong investor loans money to Jenny. Jenny has to pay £10,000 in interest. Just imagine that number for me, please. You've got an expense in Hong Kong, haven't you? You owe somebody their money back plus 10 grand.
Yeah.
Good. If you don't organize that effectively, then what's going to happen is exactly what you've said. You're going to make a profit, but now you've got a cost. Yeah. So what I'm trying to do is move that cost on to the English company. So now Jenny can now loan money to the English company.
Okay.
And charge the English company interest.
All right.
And you charge the English company £10,000. So England pays Jenny 10,000. Jenny pays investor 10,000.
Okay.
How much profit did you make on that 10,000? Did you make a profit?
Yes, but not
Okay, my answer is no, you didn't make a profit. You received 10,000 of interest from England, and you suffered £10,000 of interest in Hong Kong.
Yes.
Jenny is sitting there with no profit on that 10,000. What is the tax? What is the tax you have to pay on not making a profit? Nil. Good. No tax.
All right. Okay.
So Jenny's now safe.
All right. Okay.
Makes sense?
Makes sense. So that's a director loan then. I just file it as a director loan.
Make sure you do the paperwork. Yes. You cannot charge interest without there being paperwork. Okay?
Sure. Okay. Thank you very much.
My pleasure.
Thank you, Jenny. Let's go next then over to Lisa. Hi, Lisa.
Hi, Mark. And,
Lisa, it's been delightful having you as one of the 5 pictures on the screen, because every time I said someone is nodding or someone is writing, it was you I was looking at.
Oh,
so,
I see.
So I know there's lots of people, but the screen only gives me 5 people. So
I see. No, it's been very helpful. I actually had the same question as Jenny, but since you already answered it, I'm going to give you another question. You mentioned disregarded dividends, but you didn't explain what they were.
You're correct. I didn't. Well done.
And why?
The situation is, if you are a British citizen, not in the UK, it is possible to get dividends from your UK company and there to be no taxation on it on your British tax return. All right. Now, as an Englishman living in England, I have to pay tax on my dividends. It's not a big tax for a large chunk of it, but there are circumstances for an expat, an expatriate, to not pay tax on that because it is disregarded. Okay. And basically the government has said, damn, it's so awkward and it's so difficult to collect this money. The amount of money we collect as a government compared to the amount of effort we put into collecting it, we'll just ignore it. Okay. There is no good reason for it other than that, I think. They never acknowledged that was their reason, but that is my belief for the reason.
Okay, that's good.
But unfortunately, it doesn't apply to British citizens.
It doesn't apply to me either, but okay. It's good to know. Yeah.
Okay, good.
Thank you, Mark.
Pleasure.
Thank you, Lisa. One very quick one, if we can just squeeze it in. This is
from
Carl.
If we're very quick.
I'll read it out. Carl's saying, Are the procedures different for a person setting up a UK company for a British citizen that is a non-UK resident?
The answer is no. It's not a lot different. What you do have to do is you do have to go through the effort to prove to us who you are. Now, that's not me being a bully, okay? It really isn't. The obligation and how it works within the UK now, we have various systems that operate with Companies House, and Companies House, and therefore the government, go to the chartered accountants and say, fine, you act as our gatekeepers. If you get it wrong, Mark, we'll get it wrong, but we'll hold you responsible. So make me a gatekeeper. So I will then say, fine, prove who you are. And you go, well, you know, I'll hold up my passport. No, not good enough. Take it and get it, get a copy signed off to prove to me by a registrar, a notary public, a solicitor, somebody, bank manager. Yes, this really is. I'll use Lisa. I can still see her on screen. This is definitely Lisa Tang. That's absolutely fine. Now I can accept that document, and now I've got it. I can now make the government happy and say, yes, I have verified her. She is safe. Okay. I have to do that with the English, but it's easier with the English. Well, sorry, I keep saying English. Obviously, with United Kingdom, Great Britain, and England, for goodness sake, what are we? So the UK. It's easier with the UK because actually you've got national insurance numbers. The tax office knows about you already. So I can actually pass on my responsibility to them and say, well, the tax office know about you. You must be a legitimate human being. Without the UK tax authority knowing about you, I've got to prove who you are. Okay, that is the only difference.
I know there's still some questions, but if you'd like to contact Mark directly, I'm sure he would be delighted to answer your questions. Let's hand things back to Simon and say thank you to Mark Barrett.
Thank you very much, Mark. Great to hear that.